It begins in silence. A vault door in Lower Manhattan, 50 feet beneath the street, hums open. The air is still, dry and cold. Behind the reinforced steel sits row after row of dull, unpolished bars, each stamped with serial numbers that trace back decades. Every bar looks identical, but together they represent the most controversial cache of precious metal in modern finance. J.P. Morgan Chase, custodian of roughly 160 million ounces of physical silver, worth over $4 billion. For years, analysts have argued about why the world's largest bank built the world's largest privately held silver position. Officially, it's client storage. Unofficially, it's a weapon, one that could tilt the global commodities market with a single internal transfer. Because while retail investors obsess over silver coins and ETFs, a few desks in downtown Manhattan and London control the actual metal that underpins the paper price. And suddenly, that metal is moving. In early 2025, COMEX warehouse reports show something strange. J.P. Morgan's registered silver, metal available for delivery, drops sharply. Dozens of analysts notice, few understand it. To most traders, it looks like housekeeping. To those who study the flow, it looks like a signal. Silver is vanishing from visible inventories, yet the price barely moves. Someone, somewhere, is taking the metal off exchange and keeping the paper price calm. It's the same pattern that appeared before the 2011 silver spike, before the 2020 liquidity panic, and before every major precious metal squeeze in modern history. Who controls the hidden stockpile? And why does the world's biggest bank seem to be locking the vault just as governments, miners, and investors are waking up to silver's strategic importance? To understand why one bank's vault movements matter, you have to see the map. The global silver market trades roughly 1 billion ounces a year. Half goes to industry, solar panels, electronics, medical equipment. A quarter goes to jewelry and silverware. The rest is investment, coins, bars, ETFs. Yet the visible stock that anchors all this trading, the silver that actually sits in approved vaults, hovers around 300 to 350 million ounces. That's less than 5 months of global demand. So when J.P. Morgan's vault reports shift by tens of millions of ounces, it's not a rounding error. It's a tremor in the foundation. All silver pricing flows through two hubs. COMEX in New York, where futures contracts trade. LBMA in London, where physical bars move between banks. J.P. Morgan straddles both worlds, clearing trades, storing bars, and writing derivatives that hedge producers and speculators alike. Its vaults in New York, London, and Singapore are part of a network that tracks every serial number and movement daily. When inventory leaves registered status on COMEX, it doesn't necessarily vanish. It often moves into eligible storage, still inside the vault, but no longer available for public delivery. That subtle shift can mask enormous changes in market liquidity. Demand for silver isn't only financial. Each gigawatt of solar capacity consumes about 20 metric tons of silver paste. Electric vehicles use twice as much silver per car as traditional engines. By 2025, global photovoltaic expansion alone is projected to require 250 million ounces annually, nearly a quarter of total supply. Miners can't ramp production quickly. Most silver is a byproduct of zinc, copper, or gold mining. When base metal output slows, silver supply shrinks. That means the industrial world and the financial world are now competing for the same dwindling pool of metal. J.P. Morgan's official role is custodian for major ETFs and institutional clients. The iShares Silver Trust, SLV, lists J.P. Morgan Chase Bank N.A., London as its primary custodian. When investors buy SLV shares, the trust adds physical bars, often into J.P. Morgan's vault. But the fine print matters. SLV does not guarantee any specific bar will remain in place. Bars can be swapped, leased, or transferred between accounts as long as weight and purity remain equivalent. That flexibility makes large-scale repositioning possible without public disclosure of motive. Behind the scenes, a web connects miners, refiners, industrial users, and banks. A Peruvian mine sells concentrates to a Swiss refiner. The refiner delivers bars to London. A trading desk hedges exposure on COMEX. A U.S. electronics maker locks in supply via a long-term contract, all mediated by the same clearing banks. J.P. Morgan is not a lone actor. It's a keystone. Its movements ripple outward through every participant who relies on its vaults and clearing services. That's why analysts study its warehouse reports like weather charts. Because when a keystone shifts, the arch can move. Silver isn't only a commodity, it's a strategic resource. It's the most conductive metal on Earth, essential for energy transition, semiconductors, and defense systems. The U.S. Geological Survey lists silver as a critical mineral. China and India both maintain strategic reserves for manufacturing security. If large financial custodians quietly reallocate silver from the open market into long-term vaults, industrial users could face shortages before prices signal distress. That's why policymakers watch flows, not headlines. By early 2025, COMEX registered inventories fall near multi-year lows. LBMA vault data shows steady outflows. Yet spot prices remain oddly calm. Someone, possibly the same custodian moving the bars, is absorbing supply and suppressing volatility. The question is why now? Is it regulatory preparation, industrial offtake, or positioning for a price reset the public hasn't noticed yet? The web is moving, but the surface stays still. The silver market trades almost entirely on promises. For every physical ounce in vaults, hundreds of paper ounces change hands daily in futures, forwards, and swaps. A COMEX contract equals 5,000 ounces, but fewer than 1 in 100 ends with metal delivery. That leverage keeps prices stable, but creates a hidden dependency. The system only works if confidence in convertibility never breaks. If too many participants suddenly asked for bars instead of paper, the exchange would have to cash settle, admitting the paper pyramid is larger than the base metal beneath it. JP Morgan sits at the intersection. It clears trades, stores bars, and hedges its own exposure with futures. When it reduces registered stocks, it may simply be matching paper obligations against physical supply. But that dual role, broker, warehouse, market maker, means it can't fully leave the game. Pull back too far and liquidity dries up. Stay too exposed, and the bank carries the world's counterparty risk. Either choice reveals how dependent modern finance is on a single custodian's balance sheet. After the 2020s volatility, regulators tightened disclosure rules. Banks must report short positions, collateral movements, and client storage levels. But transparency has limits. Much of the trading happens over the counter, outside public view. The Commodity Futures Trading Commission has investigated silver manipulation claims for decades, each time concluding there's no actionable violation, only market structure. That phrase, market structure, is finance's version of gravity, invisible, permanent, and inescapable. Every hedged miner, every industrial user, every ETF relies on that same structure. A solar panel manufacturer sells forward contracts to lock prices. A bullion bank offsets those positions on COMEX. JP Morgan clears both sides and holds the collateral. If the bank were to shrink its silver operations, spreads would widen, costs would jump, and dozens of counterparties would lose pricing benchmarks. The system traps itself through its own efficiency. Nobody can leave without everyone feeling it. Over time, the trap evolved, not by conspiracy but by optimization. Digital settlement replaced metal movement. Collateral chains replaced delivery. By 2025, owning silver, for most institutions, means holding an electronic claim whose convertibility is theoretical. JP Morgan didn't design this alone, it adapted to it. The deeper question is whether anyone still controls it. Several trends are tightening the loop. Surging industrial demand drains visible inventories. Rising interest rates make storage and financing more expensive. Retail investors buy coins faster than mints can produce them. Geopolitical sanctions push nations toward holding tangible reserves. Each factor converts a fraction of paper demand into physical withdrawal. Every withdrawal reduces the cushion, keeping futures stable. It's a slow squeeze with no headline moment, just a gradual shortening of fuse. If prices spike, industrial users panic. If prices crash, miners cut output. Either way, the long-term balance worsens. JP Morgan's task is to smooth that volatility, absorbing flows in both directions. But smoothing also conceals the true tension building underneath. When a structure depends on concealment for stability, transparency itself becomes the trigger. So here we stand. A trillion-dollar metals system built on leverage, dependent on a handful of vaults, and run by a custodian too essential to fail. Nobody's hiding treasure for a heist. They're hiding fragility for survival. But history shows, the moment confidence falters, hidden fragility becomes visible overnight. And silver, once the most ordinary of metals, can turn from ballast to spark. It's dawn near Elko, Nevada. Jack Morales, a 46-year-old underground supervisor, drives to the pit before sunrise. His mine produces mostly zinc and lead, but a few ounces of silver come out with every ton of ore. Lately, the company's been cutting exploration budgets. Costs are rising, and futures prices haven't kept pace. Jack knows why. Traders in New York decide silver's value before it ever reaches daylight. He flips through market headlines on his phone while sipping burnt coffee. COMEX inventories stable, one reads. He laughs quietly. They're stable because someone else is paying to keep them that way. 6 states east, in a solar panel plant outside Toledo, Dana Wu checks the line speed. Her machines coat photovoltaic cells with silver paste. Each panel uses a few grams. When prices tick up, procurement freezes orders. When they drop, the CFO says, "See, we hedged perfectly." She never sees the hedges, only the bottlenecks. Last month, delivery from the supplier in Japan slipped by 3 weeks. The metals broker blamed tight physical markets. Dana's workers wait idle, though the global price chart shows calm. She suspects the calm is paper thin. Meanwhile, in Phoenix, retired engineer Tom Esposito scrolls through his online brokerage account. He's owned silver ETFs for years, expecting inflation to lift prices. But the charts barely move, even as costs rise everywhere else. He reads forums claiming banks suppress silver to protect fiat confidence. He doesn't believe in grand conspiracies, but he can't ignore that the largest custodian keeps shrinking visible stocks while reporting healthy liquidity. So he does what generations before him did, buys a few physical coins, just in case. In 1980, the Hunt brothers tried to corner the silver market. They borrowed against oil wealth, bought futures, and demanded delivery. For a moment, it worked. Prices soared above $50 an ounce. Then margin rules changed, liquidity vanished, and the paper system reclaimed control. That event scarred regulators and banks alike. It taught them 2 lessons still visible today. Real metal can upend paper balance. The system will always protect stability first. JP Morgan's massive inventory decades later is the institutional version of those lessons. Control the supply chain, control the calm. Older miners remember another precedent, the U.S. government's own stockpile. During the Cold War, Washington held more than 2 billion ounces of silver for coinage and defense. By the early 2000s, those reserves were gone. Every missile guidance system, every photovoltaic cell now competes with investors for the same industrial metal. Governments learned to let private custodians manage it. The public only sees the price ticker. In 2025, these threads, miners squeezed, manufacturers anxious, investors restless, cross paths invisibly through JP Morgan's vault ledgers. Each person depends on the same quiet equilibrium. None can influence it. That's what makes it powerful. A system so efficient it erases human fingerprints. The illusion of calm holds because no single participant can afford to break it. But equilibrium never lasts. Inventories are finite, and demand curves aren't patient. Somewhere between Jack's mine, Dana's assembly line, and Tom's brokerage account lies the moment the math stops working. When that happens, price isn't the first thing to move, trust is. Every market has 2 versions, the one we see on screens and the one that actually clears trades. In the visible world, silver drifts between $22 and $30 an ounce, charts ticking calmly. In the hidden world, bars move quietly between vaults, contracts roll over, and custodians balance hundreds of claims against the same ounces. This duality isn't new. It's the architecture of modern finance. But it means price no longer tells the full story of scarcity. JP Morgan isn't secretly hoarding silver to spark drama. It's managing the invisible plumbing that keeps the system running. The danger isn't villainy, it's dependence. Every civilization builds a tool it eventually forgets how to live without. For the 21st century, that tool is financial intermediation. We trust ledgers we can't audit, algorithms we can't see, and custodians we can't replace. When someone asks, "Who owns the silver?" The most honest answer is everyone and no one. That's why the vault in Manhattan matters. It's not just metal. It's the memory of a system that once measured wealth in something tangible. If confidence ever breaks, if too many participants ask for bars instead of balances, the illusion thins. Silver would surge not because of scarcity, but because trust in substitution vanishes. The same dynamic holds for everything built on leverage. Mortgages in 2008, repo markets in 2019, bank deposits in 2023. Each time, complexity hid fragility until it couldn't. The warning isn't that JP Morgan is plotting. It's that the market's design leaves no easy exit. Slowly, governments and corporations are responding. Energy firms sign direct contracts with refiners. Mints expand capacity for retail demand. Some central banks explore adding silver to strategic reserves. Each small step hints at a future where real assets regain quiet importance. Not as rebellion, but as redundancy, insurance against digital abstraction. That's the quiet evolution already underway. For individuals, the message is simpler. You don't have to choose sides between paper and metal, Wall Street and vault. But it's worth understanding what each represents. Paper gives liquidity. Metal gives certainty. Systems give convenience. History gives context. When all four align, stability feels eternal. When they diverge, that's when change begins. So yes, JP Morgan holds an enormous pile of silver. Maybe it's not a secret. Maybe it's the system's backbone. Either way, it's a mirror. It reflects how far we've moved from tangible value, and how uneasy we become whenever that distance grows too wide. The next financial storm won't start with a scandal. It will start with a question. Do we still believe the paper stands for the metal? When you hear headlines about banks, vaults, or hidden reserves, don't stop at outrage. Ask how those structures affect your own stability. What do you actually hold? What could you redeem if the system paused for just one day? Because in the end, every crisis is the same story repeated. A gap between what we think we own and what we can touch. And somewhere, in the quiet hum of a Manhattan vault, that question is still waiting for an answer.